what's up? I know this is a long overdue video, but I'm here to teach you how to learn how to trade stocks, options, Forex, HFX, TVX, whatever it is, gold, silver, long-term holds, short-term, day trading. I'm here to help you break it all down, and it's simple, easy peasy. So let's get into it, because I do not want this video to be long at all. And this is coming straight out of my ebook that I sell. And y'all getting it for free. So shh, don't tell nobody. Like, I'm giving this information to y'all for free because more people should know how to do this skill. Like, and this is a skill you can have forever to make money forever in your bed. But let's get it. This is about market investing. First thing first, you're going to need to learn the terminology. I know you always hear somebody say, oh, it's a bull's market. Oh, it's a bear's market. Or are you doing calls or puts today? These is just trading language. It's just the language in trading, basically. So all a call is that the market is going to go up. You think it's going to come up. A put means that you think it's going to go down. You put down the phone. When you think of a call, you picking up a phone. And then the put, you're putting down the phone when you get off the call. Easy way to think about it. For bulls, raging bulls, they're going up. They raging. So that's how you know it's going up. Bears, what do they do in the winter? They hibernate. So hibernating bears, they're going down for the winter. That's how you can think about that. And I know you hear about people always saying like brokers. You have to pick the right broker for you. What is a broker, you may say? A broker is just a facility that you trade on, basically, or even a person. The broker could be a physical person, such as these examples down here. These are brokers. Pocket Options, Webull, IQSend, Robinhood, Coinbase, all these are brokers. After you learn the terminology, you want to know what investing looks like. And what does investing look like? It looks like investing long-term or short-term. Long-term can be 10, 20 years from now. And short-term could be today, in the next 3 minutes or the next 1 minute. Day trading is another short form of trading. It's you trade within the day. Like, and people may say swing traders. Those are people that may trade once or twice a week or 2 or 3 times a month. It's just different technical words for those. And stocks. Stocks are ownerships of a fraction of a corporation, and then you can be paid in dividends from owning these stocks. Crypto is just digital currency, such as the US dollar, USD, or the yen, the Japanese yen. Those are, and that'll be JPY. Those are digital cryptocurrencies. That's what crypto is. Bitcoin, Ethereum. I know you've been hearing people saying, oh, Bitcoin is going crazy. And or if you missed out on the Bitcoin wave, or I know y'all heard about the Shiba Inu wave. Like, come on now. Those are all cryptocurrencies. And I know y'all heard about Akon trying to make his own acorn or whatever. These are just different digital currencies. And yes, you can trade them as well. You can invest in them as well. And these things could potentially make you money if you know what you're doing. As well as metals. Metals are things such as gold, silver, and things of that sort. You can trade these things as well. Like, they have it all. They can be traded like in HFX, which is a high frequency time-based trading. So you can make trades less than a minute and make money, or you can make trades in 3 minutes and make money. I like to trade 3-minute trades because I like fast money, high risk for high reward. But they are just really they are different things, but they are kind of all the same. So if you're trading HFX, TBX, binary options, Forex, whatever it is, you're going to apply this same knowledge to do all of it. Like, you can apply this same knowledge to trade all of it. It's really just like it's a Toyota and Kia. They're just different company, different things, different segments. After that, you're going to want to know how to apply TA. TA is technical analysis. Technical analysis is going to be your best friend. Like, this is what I'm telling you about. This is what you're going to apply to anything. You can even apply this in your business, like, or even in your Etsy stores to see when is the best time to sell product, or when is your product selling the best. So technical analysis is going to be your best friend. This is the base of it. This is where you find out, oh, where I should get in, where I should get out, if this is a good one, if this is not a good one. Analysis that uses patterns in the data to identify trends and predictions. So basically stuff that's happened in the past is happening currently. Or if I say 1, 2, 3, 1, 2, 3, 1, 2, 3, what you think I'm going to say next? 1, 2, 3, right? Because it's a pattern. It's something that you noticed. I kept saying, so you're like, oh, she gonna say it again. It's a pattern. And I'm telling you, this is gonna be your best friend. This is everything. This is the foundation. And technical analysis is not always 100% perfect or predictable. Like, because news can cause the market to go upwitching ways, like such as Tesla when they have the cars crashing and stuff like that. That caused the stock to come down. But you could be looking at your technical analysis on your chart set up, and you could think it could go one way, and the news will come in and it'll wipe it out. And that's a limiting factor, which is as well in here, which we'll talk about later on. Before you enter the market, this is what I was saying a little bit before about the news. Before you enter the market, there are some crucial things you want to do. If you're trading like crypto, digital currencies, you want to get on this website right here. I got it over here linked. I may have it linked. I don't have it linked, but you can see the name on it. It's on that picture. It's live charts. And that's where you would want to go to check your strength-o-meter for your currency pairs. And if you read it, I give you information on the side to identify which way it could possibly be going before you even set up any other indicators on your chart. When you have a currency pair that is in the front, say you have USD/Japanese yen, you would want to go to this website and look, and you would say, oh, where is USD? Okay, is USD bigger than Japanese yen on this strength-o-meter chart? If it is, because USD is the first one, you're potentially looking for calls. And if the second one, which is the yen, would be the highest, and the first would be the lowest, then you would be looking for a put. That means it could potentially be coming down. And you can reread this on the side over here if that was a lot to process or a lot for me to say. Like I said before, cryptocurrencies are digital currencies that you can trade on those broker websites. And before you get on that market, you want to look on this website to even get a picture of where like your mind could be or where the market could be going. So once you pick your pair, you be like, oh, I want to do USD in the yen. Then you want to get on this website, look which one is stronger than the other. And when you see, oh, the first one's stronger than the second one, okay, I'm potentially looking for a call. The market could go up. Or if you see the second one is stronger than the first one, you know, oh, I'm potentially looking for a put. This market can come down. And like I was saying, news, that can affect your charts. You want to watch the news or read the news or see what updates are on these broker apps, because they have news in the apps as well to see what's affecting the news. Like I was telling you, you can have your charts completely set up, and Tesla can say, oh, we had 150 cars just crash out of nowhere. People are not going to like that. So that's going to affect the stock to come down and not go up, even though you might have thought it was going up because your technical analysis said that. but your news can tell you otherwise. Or it could be like a big election. Normally during the election year, the market is always higher. So you would think, oh, I could buy more. I should be looking at more calls because it's a presidential election year. And normally in presidential election years, the market is higher. Oh, so let me see what's going on with the news. So you just want to do that. And another big thing is FOMO, fear of missing out. If you miss an entry, it's okay. You always can find another trade. It's always going to be another entry. Like, it's okay if you miss out. It's okay. Revenge trading. This goes to the FOMO. You fear of missing out on your entry and you like, oh man, I missed out on my entry. I want to get that money. And you go in there and revenge trading. You get in there and you get an incorrect or a bad entry. And now you done looking stupid because you done lost some money. Or you confused because you like, what? It was going my way, but you didn't get the right entry. Or you can lose a trade. Like me, I do like 3 trades a day. I got risk management. I don't trade more than 5% of my account, which everybody should be doing. You shouldn't trade more than 5 to 10% of your account. That's how you blow your account. Small losses make bosses. That's what Keenan Grace says. But if you lose a trade and you be like, oh, I want to go revenge trade. I want to place another one and get my money back. That's not good because you already lost a trade on that one trade. So possibly you could lose again on the second go round, or you're just revenge trading. So your brain is not really on the technical analysis. Your emotions are in and out. So you're like, oh, I got to trade. I got to get this trade. I got to win my money back. And you keep losing because you're trying to win your money back. Please don't do that. I've done it a lot. When you get on a chart, the first thing you are going to see are those candles. And you be like, what is going on? What's all these candles? What's these lines? And if you see the line, you want to go in and you want to find the settings and change it to Hachi-Nachi candles. Hachi-Nachi candles. And this is just a Japanese terms. These are the most frequently used candles in technical analysis. We don't make the rules. This is just what they've been doing for 100 years plus, and it's worked. They've made money. And here I'm just showing you a picture and explaining the candles. Show you the strength in price. So you want to buy / get a call when candles are flat at the bottom, and you want to sell or get a put when they are flat at the top. So if it's not a wick and it's just a flat bottom, it could potentially go up. That's another signal. If it's not a wick and it's just a flat top, it could potentially come down, which I have shown in the picture over there, not this one. How to apply these candles. These candles are used to identify trends. Like I was saying earlier, if I say 1, 2, 3, 1, 2, 3, 1, 2, 3, you're going to know. You use indicators to go with these candles to help you fact check, to make sure that you are correct. Indicators are just used to help give you other signals. And different indicators can be RSI, MACD, your 1348 cross, which is actually like strategies. So basically, indicators are like trading strategies. That's really all they are. Support and resistance is going to be very important. So I have a picture up here in the corner of a consolidation trend. There are 3 types of trends: uptrend, downtrend, and consolidation. Consolidation is just flat, straight. An uptrend, y'all would know it would be going up. It'll look like that. A downtrend, y'all would know it's coming down. It'll look like that. So in this consolidation trend, I am trying to show you here how to set up your support and your resistance. Your support will be at the bottom line. Your resistance will be at the top where they are touching. Multiple tops are touching. If you look at that picture, it's in between. It's just bouncing in between those 2 lines. This is a consolidation trend, which you could trade here. You can buy puts at the top of the resistance. So when it comes back down to the support, you can make money on the way down. Or you can buy at the support and ride the wave up to the resistance and make money on the way up. This is called the bounce strategy. Or supports it because it doesn't want the price to drop any further. A resistance from coming any higher. So basically it's just bouncing between these two levels. And as I explained before on the last slide, there are multiple uptrends, downtrends, and consolidation. Here I am just showing you pictures and examples of all three and their support and resistances. Indicators and pattern trends. What goes up must come down, and in reverse. What goes down must come up. Yeah, I know you've heard that, like gravity, like that's how stocks are too. What goes up must come down. What goes down must come up. So it's easy. With the RSI, it's the relative strength indicator. If it is over 70, it is overbought. So that means the market must come back down. And if it's under 30, that means the market is oversold. It must come back up. So when you go in there in your settings and you hit RSI, it'll just be there for you. You'll see the lines and you will see this. I think I have pictures in here as well so I can give you a clearer example. But when you select that indicator, that's an indicator right there to let you know if the market's going up or if it's coming down. If it's above 70, yeah, I know what I told you. It's coming back down. If it's below 30, it's coming back up. What goes down must come up and in reverse. Okay? The stochastic oscillator, it measures momentum. And basically, it's the same thing as the RSI. If it's over 70, it must come down. If it's under 30, it must come back up. These are really indicators that are kind of the same, but they are different. The MACD, it gives you the crosses. It'll come up and it'll have two lines on it. So when the lines are crossing up, the market's coming up. When the lines are crossing down, the market is coming down. Easy peasy. And I'm glad I got it right here because pictures are great. The RSI is right here. How it works. You see how it's overbought when it hits that 70 at that top peak and it come back down? Yeah, and you see down where it say oversold on the 30 on this one and it came all the way back up. What goes down must come back up. And this is how these indicators look. The stochastic oscillator is right under this one. It's right here. And when you look at it, don't look at the chart. That's just the chart at the top. Look at the bottom where it's showing you where it has purple. That will be your stochastic oscillator. You see how it's kind of similar as the RSI? When it gets to that top level of 70, it's coming back down. When it gets back to that lower level at 30, it's coming back up. That is another indicator. These help you. And the MACD is right next to this how the RSI works. Then you can pay attention to the chart, but for right now, don't pay attention to the top part of the chart. Look at the lower level. Do you see where the circles are in those points? Those are cross points. And remember, go back to the terminology when we were talking about bulls and bears so you can know which way it's going. So that first cross, it shows that it's bearish. The hibernating bears are going down to sleep. The MACD is crossing down. So that gives you an indicator that the market is coming down. The one right next to it is a green one and it's down below at the bottom. It's starting to cross up. It's raging bulls. It's coming up. The bulls are raging. And it's crossing upwards. These are just indicators to help you indicate more which way the market is going to go in your favor. And if you, if you look at the chart of the MACD indicator, when the market crosses, you can tell on that top chart, oh, it was coming down. And they show you on that bearish one, it shows you that red line coming down is that yellow first cross. It start coming down, then it start coming back up when it got down to that lower level, when it start crossing. And as well, when you look at the chart on the MACD indicator, it shows you those points from the arrows of when it crossed. And it was like, oh, you see that downtrend going out because it crossed down. Up, you see that uptrend. Let me break down more indicators. Moving averages. There's a simple moving average and exponential moving average. The moving average shows the average moving price. There are two types of moving average, a simple moving average and an exponential moving average. Exponential is the one that is mostly used because the candles are weighed heavier. The newer candles, so it's basically the newer candles are way heavier than the older candles, and the simple MA weighs all the candles. So the exponential is used more when you're trading, especially on a higher frequency time. Like if you're trading 1 to 5 minutes or day trading, you definitely want to be using this exponential because these are your current candles and not everything from far behind. Another one is a 1348 cross. So you want to set up your EMA, you want to set them to 1348, and boom, you got your 1348 cross. And you get your 1348 cross. It's going to be just like the MACD indicator. If you can go back on the last slide like I showed you, it's going to show up crosses right on your chart, not just in the indicator section. So you'll have that's even more. There's a 450 cross. So you want to set 1 to 4, 1 to 50, and 1 to 200. 200 EMAs are always used. Always used. It's good. It's used for a good support or resistance. This is where, like, if you are, this can make or break it. So if you're seeing like, oh, this is a call. I'm thinking like all your technical analysis is showing you that the market is going up, but then you see your candle sitting right on your 200 EMA. That's a candle that's a signal of that's where you could be stopped at. And if it's like not a large gap, like say your candles are right here, top of your wick or your candle is right here and your 200 EMA is right here. That's going to be a hard level to break. So that means you're not going to have a lot of wiggle room before it come back down. The 200 EMA is crucial. Like crucial. Let's keep going. And I'm glad. I told y'all pictures are the best. This is the only way you're going to learn. So here I am actually showing you my MACD cross. That is in MACD where I'm pointing it at, that red arrow. Right under it is the RSI as well. The RSI is not at 70 yet, so it's not overbought. So it can come up some more. My MACD is crossing upwards, as you see, and above that is the stochastic oscillator. And on my chart, you can as well see my 450 cross, which I have my other arrow where it says moving average cross entry. This is a great entry point right here. Your 450 or your 1348 cross is crossing up on your chart. Your MACD is crossing up. Your RSI is not at 70 overbought yet. So this is a strong signal to buy for a call. And I actually made money on this trade because I knew, let me get in right here because I got my MACD crossing, my 450 crossing, and my RSI can come up some more. So I made money. And of course, as well, like I was saying before in the beginning, when you choose a pair, this is Euro CAD. You want to go check that live charts to see which pair is stronger than the other. So if my Euro is stronger than my CAD, I would be thinking to go for calls. If my CAD was stronger than the Euros on that chart, I would be thinking to go for puts. Or good entry, or even better entry would have been at the bottom. But you see that white line, that's a 200 EMA. So that's kind of scary to be at, low key. But it's crossing up. I got my crosses. So I had no doubt that it was still coming up. I got two crosses, my MACD and my 450 cross. and my RSI can come up some more. It's not at 70. So I took this trade and I won money. And as I was saying, there are limitations that can stop you or limit you from making money, such as false breakouts. These can be breakouts as I have in this picture up here. It says false signal limitations. It could come above your resistance line and you can think, oh, it's going to break out. It's going to keep going up and keep running up, and it comes back down. This is called the breakout strategy when people are trading the breakout strategy. And when you're doing that, basically you have your support and your resistance set up and you think you're going to get a candle that lives totally above or a candle that lives totally below that line, such as there where it's circled. You have a candle that lives totally above, but it comes back down into your zone. It comes back down underneath that resistance point, and that is a false breakout. So you will definitely have to watch for those. And like I was saying, news, when I was explaining Tesla in the beginning as well. And of course, I was saying in the way beginning, it is not 100% predictable. But I mean, people have been doing this for years, so I kind of think it is, but not always. It's not. But let's get to the breakout strategy so I can show you more about false breakouts. I believe that's on my next slide. Yes, it is. So breakout strategy, like I was saying, if it's, you think this is a breakdown, so you think it's gonna be a put, so it's breaking out downwards, it's coming down, you think it's coming, it is coming down on both of these pictures, and it could be flipped the other way, and then it could be going up. Basically, you want a full body candle to live totally below your support or your resistance level, whichever way that you think the market is going to go. In this case, we're going to look for puts. You see how we have that candle that lives totally below that line? That's how we knew that this market is finna keep coming down, because it broke our support or it broke our resistance. And this is how people trade the breakout strategy. You see how these are consolidation trends that turned into downtrends because they broke out of that consolidation and turned into a downtrend. And when you have your support and resistance set up on your consolidation, you know what they do. They bounce, like I said in the beginning. So when it breaks that level, you can say, oh, I want to get in for a call, it's going to go run up. Oh, I want to get in for a put, it's going to run down. And you can make money. And these are just strategies and indicators that I use. A whole lot of other traders use to make money. I've made money using these strategies. A lot of people made money. Like, if you go follow Keenan Grace, he uses these strategies and he makes money. I mean, a lot of it on options. So, yeah. And I'm just going to do a quick run through of the strategies that were shown and the slides they were on if you want to go back to it. But your crosses, your breakout, and your bounce strategy. The cross strategy is when you find in your MACD cross, your 1348 or your 450, when I was showing you where it was crossing. The breakout is where I just showed you on the last slide, and the bounce is where I showed you in the beginning of consolidation when I was telling you it can bounce in between those two lines and you can ride that support to the top to that resistance, and then you can get at that resistance when it hit it and then get in for a put and ride it back down to the support. And for buying and selling options on Robinhood, this is another one because you need to learn like the terminology for those as well, such as delta, gamma, theta. There is rho, but it's not as important. Delta basically is just how much money you're going to make. Gamma is how much money you're going to make if you hit your point multiple times. If you keep going up, like say, oh, you have a 172 strike. You hit your 172 strike and keep going, you're getting delta plus gamma. So you're getting paid, double paid. Theta is the money that you're losing. That's what's eating away. We call it theta gata. It's eating away at your money. So you want to look at that and check that to see how much money you're losing. Say you want to do a day trade. You don't want to hold this day trade and it say you losing $50, but you only win 14. Say the delta is 14 and the theta is 50. You losing more than you winning, so you wouldn't want to get into that trade. It's not a good trade. It's not a high quality trade. So I did want to put this slide in here for you guys as well. You guys can pause and read. I didn't read the slides like slide by slide, 4x4. I literally just talked from my head and my knowledge. So if you guys want to pause and read these slides, you definitely can. You definitely should, because this is where all the information is in these slides. But I did want to talk and explain to you, like, right from my head, the information that I know, what I'm thinking, what I'm using, when I'm trading. And as well, you always want to set a stop loss. Like if you're trading, like I told you, like 5 to 10% of your portfolio. You don't want to lose all your money. You can set it manually, or you can sit there and watch it and be like, okay, I know this is 10% of whatever I put in, I'm out. Like, you don't want to lose too much money. So you definitely always want to set a stop loss. It stops you from losing more money. That's why it's called a stop loss. And when you get on like Robinhood and you want to trade options and you hit trade options, it's going to be strike price in the middle. Then it's going to have options up here and options at the bottom. Options are just contracts of 100 stocks that you can buy and sell at a lower rate. So when I just want to explain this part, because this is very confusing when you get on there. When it says strike price and you buying and you looking for calls, you're buying a call, your ones that are in the money are going to be at the bottom, and out of the money are going to be at the top. In the money means they are already winning. Out of the money means they are not winning anything yet, or not even close to it. So I did want to just throw that out there as well, because that can be very confusing, and it's vice versa. For when you want to buy a put, it's going to be strike price. And then if you want to buy a put, your out of the money is going to be on bottom, your in the money is going to be on the top. So I did want to put that in there because that is very confusing. And I wanted to throw this slide in here as well, you know, just so you can know the terminology for when you're looking for options. You want to know like how much money you're going to be paid and how much money you're going to lose if you hold that option, you know. And you always want a good volume as well. Like, you don't want to trade nothing that has low volume at all. If it's under 100, you don't want to touch it. If really under 1,000, you don't want to touch it, because if nobody's trading it, you don't need to be trading it neither. What? Like, simple as that. And I'm glad to share this with y'all, even though, you know, I do charge for this. But if you still want to buy it and you want to have it just in hand on your phone, physical, you can always buy it. I'll have the link down below in the description box. I hope I dumbed this down and broke this down to y'all like as good as possible. I hope y'all understood, and I just hope y'all go back and read and pause, and I hope y'all learned something, or learned how to trade stocks, or learned a strategy, or what stocks are, or just learned anything from this video, because more my skin people need to learn about this. Like, you don't gotta be a Wall Street guy with a tux and tuxedo and all that to be a trader. Like, you don't. And like I was saying, for Forex, you can use all this for anything. Forex uses things like terms like pips. It just measures the amount that the market is going up. It's a foreign exchange market. That's all it is. Like, everything is just different, just like the stock market or options market. They're just trading different things, different currencies. That's all it is. Like, and that's the end. I hope y'all learned something, and I'm sorry that this video was like long overdue, but I finally did it, and I hope y'all learned something. And if you got any questions, please ask me. Like, I do 101s for $50, only $50. And if you want this ebook, physically, you can buy it for $25. So I appreciate y'all, and I hope you learned something. And please comment, like, subscribe. Comment, like, subscribe. Comment, like, subscribe. Let me know what you learned, or if you learned something. Like, I gave away 3 strategies. I gave away all my indicators I use. Like, this the tea. You can go make some money now. Study this and go make some money.